All right, we're going to talk about paying off your mortgage biweekly. There's a lot of videos out there that say that this is the best thing since sliced bread and you get to save a ton on interest. I am in a series with Todd Langford, the founder of Truth Concepts, and we're trying to set the record straight as it relates to truth, money, and how all of that works. We did a video before this, and if you have not watched this, it's all about the 15-year mortgage versus the 30-year mortgage. And we do a deep dive on all things opportunity cost, interest rates. We look at a ton of factors. We even mix it up and just say philosophy. It's a much watch if you're someone who's thinking about what you should do in a mortgage, or whether you're an advisor or a coach or someone that helps people with money. Like, I would highly recommend you even pause this video and watch that video first, because it's going to give you a solid foundation. But then we're going to continue that conversation and say, how do we take that same logic and what we talked about and address it to this thing that's been going viral on the again, what I call it, like the new magic wand of paying your mortgage bi-monthly or bi-weekly, and you get to save all this interest in this magical thing.
The banks won't tell you this. Here's how you pay off your mortgage 3 years faster. If you set up to pay bi-weekly payments rather than monthly payments, you end up making one extra payment per year. It might not sound like much, right? But it actually is. So just one extra payment every year will shave off 3 years off of a 30-year mortgage and save you tens of thousands on interest.
Did you know that making bi-weekly mortgage payments will knock 7 years off your mortgage? But here's what you need to know. So first of all, when I say bi-weekly payments, I don't mean doubling your mortgage payment every month. What I mean is you're taking your mortgage payment, let's say it's $2,000, and you're dividing it in half. So let's say $1,000, and you're taking that $1,000 and paying that payment every 2 weeks. So what that means is that instead of making 12 full monthly payments, you are actually making 26 half payments, which equals one extra payment per year.
And so without further ado, Todd, welcome back. And I'm excited for this video.
Thanks, Caleb. It really is such a confusing, emotional area, the mortgage, right? And there's so much information out there, and unfortunately, a lot of it's just not true. But it's based in some truth, right? It's just not the whole truth necessarily. And part of that has to do around interest rates. And like I say, we talked about it in the last video a little bit, and it's so limited when we don't have opportunity. We don't talk about time. I mean, it would be correct if everything was about today, but when we're talking about over 30 years, we have to add the element of time. And so what happens with this idea of the biweekly mortgage, so if you think about it, people think that it's magic. It'll trim 7 years, 6 years off my mortgage and save, $80,000, $100,000 in interest that I'm going to have to pay on that mortgage. But it didn't come for free. And so the magic is not the biweekly, it's the amount of money that's going in. And we're going to break that down. And so what happens is when we pay biweekly, we're actually paying 26 payments a year. We've got 52 weeks in a year. If we pay every other week, we're paying 26 payments. Now, all except for February, most months are 4.5 weeks long, right? So we actually, on the biweekly, since we pay 26 payments that are half of what our monthly is, we actually pay 13 annual payments. So the magic really comes in the fact that we're making an extra payment every year on our mortgage. And so people look at it as free. Hey, I'm just paying the same amount because I'm doing half a month in 2 weeks, but it's not the same amount. It's an extra payment every year. So we're putting more money in. So we'll break that down and see what that looks like, right? Does the premise kind of make sense so far, though?
Yeah. I'm nodding my head. Premise makes sense.
But before we jump into the biweekly, what I want to do is, for those advisors that are out there, what we went over last time with 15-year versus 30-year mortgage can be a little daunting your first time through with the different calculators that we use just to prove and help understand what we're doing. So there is a macro here that is the macro mortgage length comparison calculator. And it will step you through all of the calculators as you go through it and bring those pieces and parts up, just like we did in the last video, but with some prompts and guidance. So it's easy to get to that point until you're comfortable with how those numbers work and you can see them over and over again easily. Okay, so let's step through what we did last time quickly. And so here we have our $400,000 mortgage. It asks us the mortgage length. It asks us the time for the rate On that mortgage, we used 6%. It wants to know the longest mortgage time, 360. It wants to know the time frame for the other mortgage, which is 180. It comes up and shows us the two mortgages, the difference in the interest rates or the cumulative payments over this time frame. And then now as we step through, we can see what happens with cash as well. So we have the 30-year mortgage, the 15-year mortgage, and cash, and what those cumulative payments would be over this time frame. And we see on the 30-year mortgage, $463,000 of interest above and beyond the principal, $207,000 above and beyond the principal on the 15-year mortgage, and zero interest above and beyond the principal on the cash option. When we go to next, we can see here that that decision to take $400,000 out of our cash to pay off the house would actually cause us to lose the earnings that would have grown that out to $2.4 million over that time frame. So while we look at no interest being paid, it actually caused no interest to be earned on those dollars as well. And so when we don't earn it, we lost over $2 million by making that decision. But if we did that, we would free up the payment that we have on the 360-month mortgage, and we could funnel that into a side fund at 6%. If we did that, look at that. We end up with the same $2.4 million. So either one of these decisions, at the 30-year mark, our house is paid off and we're going to have $2.4 million as long as we're disciplined, right? And then if we look at the 15-year mortgage, the first part of it, just the first 180 months while we're making a payment, grows to $981,000. But that, in order to be valid, has to have the same illustration period, and we take that out the rest of the time frame. With no additional payments, we see, that's the same $2.4 million. So either way, either of these three decisions actually have the same gross cost when we include time in the form of opportunity cost, right?
That's right.
Okay,
That's right.
when we go to next, here we see across the top, 2.4 million, 2.4 million, 2.4 million. Any of those decisions, when our interest rates are the same, are going to result in the same gross cost. Now, if we could deduct this mortgage, as we can in the US, in a 24% bracket, then what we see now is the one that's supposed to be the most expensive, that 360-month mortgage that we pay more interest on truly than the other ones, it actually net of our tax deduction is the least expensive. Again, assuming 6% on all the costs. And here we see our 2.4 million, and both of them is the gross cost, but that longer mortgage gives us a larger tax deduction and therefore a smaller net cost over that 15-year mortgage. Okay, so one of the things that we didn't talk about last time we went through the video, and that is how inflation, actually, this is one of the areas inflation helps us because it's going to reduce the way that payment feels. It's going to be a level payment all the way out of the future, but because inflation is pushing the cost and everything else up and this is staying flat, it actually reduces. And so think about it. That's part of the reason the banks offer us a lower rate for that longer mortgage. They don't want those deflated dollars out in the future. But if we just look at this on that longer mortgage, and let's say we had a 4% inflation rate, that $2,398 payment today is only going to feel like $723 out there 30 years from now. It's still going to be the same $2,398 payment. It's just that our income and everything else has gone up while this didn't. And so it actually has the impact of feeling less out there in the future.
Yeah, I'll just in summary, if you have not watched the first video that Todd and I went through, highly recommend you go through it because there's a lot of conversations that we have. But in summary, if the numbers are the same, you can't say a 15-year mortgage or paying off, cash. Yes, you save interest, but you need to factor in what you could be earning. And at the end of the day, at the same interest rate assumption, it's identical. But then when you start factoring in tax advantages, inflation, opportunity of potentially having extra capital versus not, like when you start factoring in other scenarios, there tends to be a lot of benefits of potentially using a 30-year mortgage as a tool. Investing the difference potentially could give you more options and whatnot. Or if you don't have any discipline, if you have zero discipline, you're going to spend the difference. You can make the argument that a shorter mortgage or maybe even paying cash for something is great if you're just going to spend the difference. So I think the math can only take us so far. You ultimately have to use facts and translate that into what am I going to do with my situation and the outcomes that I want. But at the end of the day, this alone could be an amazing summary for people to take a step back. So with that, Todd, let's talk about the biweekly concept of, taking the same quote unquote payment, paying biweekly, but you even said early on in the video that you're actually adding an extra month, which is great. But again, that's people's point. They're like, yeah, exactly. Like I'm almost tricking or helping people, encouraging people to pay extra towards their mortgage, and voila, you pay off your mortgage in 7 years less by not even overpaying that much. It doesn't feel like that much, but it's like this magical thing that like knocks off years of my life on the mortgage payment and helps me save a ton of interest.
Well, and think about it before we get into it. What it's doing is, so when we shorten our mortgage time, we're increasing our payment, right? We're increasing our opportunity cost. It's more of our resources rather than going to savings or having to go into the mortgage when we make that decision. Well, a biweekly mortgage is really, it's that same impact, right? It's going to shorten the mortgage times. But let's walk through it where it's a little easier to understand. So if we can clear this out and let's put in our 360 months is our illustration period. Again, we're going to go the longest of our mortgage time frame. We'll use the same $400,000 mortgage that we did before. And let's use the same 6% rate and 360 months on this side. And let's look at the comparison. And we'll look at loan 2. So this is just keeping our 30-year mortgage all the way out. Now we have to kind of trick this a little bit to get the information in here. So we've got $400,000 over here on this one, but I want to change my payment. And so let's figure out what our payment ends up being. And so what we're going to do is we're going to get just a handheld calculator, and we'll use our same 2398.20 divided by 2, right? Because we're going to pay half of that payment every 2 weeks, $1,199 every 2 weeks, right? But we're going to make 26 of those payments, correct? So
Correct.
Times 26, and let's divide that by 12. In other words, thinking about the same monthly time frame. And so rather than effectively paying $23.98 a month, we're actually going to pay closer to $25.98 a month. So let's take this $25.98, right click on it, calculate, type in $25.98.05. Okay, so what happens here is when we pay a bi-weekly payment off of a payment that is monthly $23.98.20, it's the same thing as paying $25.98.05 every month, because we're actually now paying 13 monthly payments, because there's, again, 26 bi-weekly payments, and half of that is 13. And that's where the quote magic comes from and why this shortens the time frame. And if we scroll down, by paying that additional payment, it has the impact of paying this mortgage off in 295 and a half months, right? So there's 5.5 years ahead of time. Mm-hmm. And what that does is, from an interest standpoint, if we look at our cost summary, we can see, and this is where a lot of people talk about this, we've gone from $863,000 on the longer mortgage, the 360-month mortgage all the way out, which means we paid $463,000 in interest, right, above and beyond the principal, versus $766,000 or $366,000 in interest. So there's almost $100,000 difference in interest paid by paying that biweekly mortgage. But it's not any magic in the biweekly. It's simply in the fact that we're making an extra payment every year, right? It's just more money going in. But just like we did before in the example between the 15-year and the 30-year mortgage, we have to account for those cash flows. It's not just interest, but it's interest and time and opportunity. And when we look at that, if we put 6% savings rate up here on both of these,
should be identical.
It's actually not, because we put more money in up front.
That's okay. Yeah. I guess if I'm factoring in, if you save the difference of you take
It would be,
yeah,
yes.
yes, but yeah, you're correct. Off of these inputs, you're correct.
Yeah. And so what happens here is, because we're applying more money to it and shorten the time frame, we actually have a cost it's close. It's just barely, just a little bit over what it is on the full pay mortgage. It's really not a big difference between these two. And yet we paid $100,000 difference in interest. And that's where the hook is. That's where we get fooled into hearing about things. And it's true, we do pay less interest, but that's not really a measure of anything, because time is not in that equation. And so I know that's a difficult way to look at it, but think about it like this for just a minute. So we paid an extra payment every year, right? What if we saved that payment in a different spot for 6? I think this will help bring it around. Yeah. So copy that payment of $23.98.20. And if we chose not to do the biweekly, we would have that we could grow out into the future. And so let's get a future value calculator. And what I'm going to say is, we don't have the whole thing at the beginning. We spread it out through the year, right? So to be closer to being accurate, what I want to do is go ahead and paste that into the annual payment, and then we're going to adjust it. What I want to do is divide that out over 12 months.
Yeah.
And so click back in there on that and go to the beginning of it, put an equal sign. And at the end of it, divided by 12. So it's $199.85 a month, basically, over 295 months at 6%. And put that on top and scroll down. And look at that. We have enough to pay it off.
Yeah.
So the difference is, it didn't do anything for us from the standpoint of paying off our house. It did pay it off faster, but at a cost of not having that money sitting outside of the house where we have access to it in the event of an emergency, or ideally an opportunity, right? And so it's just a shift between the two. It's talked about being this great savings vehicle where we saved $100,000 over the other one. We're actually in the same spot, except we have less options.
That's right.
Because now the money's tied up in the house where they may not let us have it, versus having it outside where it would serve us in an emergency or opportunity, right?
That's right. That's right. So it really goes back to, if you're someone that is disciplined, you can invest, you see the value of this 100%. But there's a lot of people that aren't investing the difference. And if that's the case, at a 0% opportunity cost example, or even a negative, because you're spending all it, then yeah, there's nothing magical about prepaying your mortgage. Of course you're going to save interest. We just have to look at, you can't say that this is it's you have to factor in the opportunity cost of being able to earn as well. And I don't know if there's anything that you else want to add to that, but I appreciate you breaking that down.
Yeah, well, I think, and I know this was a little hard to get, so go back through it a couple of times and see if it makes sense. If it doesn't, comment, and we'll adjust. But this is the bottom line. I think there's a difference between interest paid and interest cost, and that's where the big difference is. And people have lumped those in to mean the same thing, and they're really completely different. That's right. Cumulative interest is not the same as interest cost.
That's right. No, I appreciate you breaking this down. And a couple of things I just want to say: if you're an advisor, if you're someone that's like, I would love to use Truth Concepts in my meetings as I break this down, there'll be a link down below to Truth Concepts for you to learn more about that amazing calculator suite, education, community, and all the things that are included with that. And then if you're someone that's like, man, I want to learn more, I want to talk to someone as it relates to that knows this stuff, there'll be a link also for the consumer who's watching this, is like, I want to talk to someone who knows what they're talking about. And then we'll also have a book. If you're like, hey, I want to read a book that helps me flesh this out more, we'll have a book down below. So lots of different call to actions, but we desire to help people really take their next step as it relates to their financial journey. And hopefully these videos can help counter or get you to start thinking differently from a TikTok or a YouTube video that's really selling one strategy based on a half truth, or it's like true, but they're not factoring in the opportunity cost of what you could do in that scenario. Anything else, Todd, that you want to say as we talk about biweekly payments?
Okay, so this was a little confusing, I know, but let's just reiterate one point, and that is if we were to funnel that difference in that payment each month into another account over the 295 months, in other words, the time frame when that accelerated mortgage by doing the biweekly option would pay off, if we didn't do that and we funneled that money into another account, we'd have $134,000, let's call it. And if we look down there on our 30-year mortgage to that 295th month, look at that. We have enough to pay it off. It's basically the same dollars. I could either put them in the mortgage all along the way and have it paid off at that point in time, or I could collect it outside and have enough to still pay it off at the same point with the same cash flows. And that's the part that's kind of left out of the analysis. The thing we need to think about is the opportunity along the way by having this side fund that's growing that could protect us against loss of job where we couldn't make our mortgage payment. Now we'd have a source of getting those dollars to do that. But then this is also dependent on whatever interest rate we earn. It might be less than that, right? If it was, say, 4%, then it's only 100, so we wouldn't have enough to pay it off. But it also might be a lot more than that. What if it was 8% instead? Wow, we'd actually have $50,000 more in that scenario just in cash with that differential, depending on what we're doing. So there could be a drastic difference between the two, but let's just assume it was the same as our mortgage at 6%. There's another factor here that I think is important, and it goes back to what we talked about in the last video about what happens when we accelerate the payoff on our mortgage. When we do that, we actually reduce the amount of interest and therefore reduce the amount of interest deduction. So even though we see right here, we're basically in the same position. If we could earn 6 outside, our mortgage at 6, we'd have enough to pay it off in the same time frame as long as we're disciplined with our cash flows and spend exactly the same amount of money in either scenario. But what does that do to us from the standpoint of getting our tax deduction? So now if we put 24% on our tax brackets on both of these, we're actually going to have a higher tax deduction on that longer mortgage because we're not eating up that interest as fast and therefore our tax deduction. So even if they were the same mechanically at the end of that time frame from spending the same dollars, we also have the advantage of an additional $50,000, $30,000 or $48,000 in tax savings. And that may not show up in a place where we can see it easily, but in our overall financial picture, it should, because that's going to offset taxes that we have to pay on other savings vehicles that we have, right?
Yep. I can guarantee you that the TikTok videos don't go into this much detail when they're talking about the biweekly payments. Todd, thank you. I also just want to say we are putting together something on velocity banking. We're hearing a lot from people about this concept of velocity banking. So if that is of interest to you and you have questions, please put that in the comments and subscribe to this channel because there's going to be more conversations to come, and we're going to continue this quest on trying to shed truth into every area and not just look at what sounds good, but like really say, what does the math say about certain scenario A versus scenario B? Todd, thank you again for taking what could be a very, very complex topic and making it quite simple using calculators. And so I appreciate your time today.
Well, thanks, Caleb. I appreciate what you're doing out there to getting the word out. I don't know if I made this simpler, but it's accurate. So watch it and watch it again. And if you have comments, send them in.
And if you want to be a ninja like this, like Todd, sign up for Truth Training. So there'll be a link down below. It will be the best couple days and money that you can spend as it relates to helping you be more confident. And so that's just a shameless plug for what you guys do. They can find out more at truthconcepts.com.